The dollar is our currency, but your problem. That line from Washington still echoes today. As the US dollar weakens, down about 10% over the past year, the shockwaves go global. So investors are turning to gold as a safe haven. As a result, gold just went on a historic roller coaster. So what's really driving gold prices? Let's break down the three key forces behind the swing. First, the US dollar and interest rates. Gold is priced in dollars, so the two usually move in opposite directions. When the Federal Reserve cuts interest rates, gold tends to rise. Markets were rattled by the nomination of Kevin Warsh as the next Fed chair, signaling a more hawkish policy direction. The shift in expectation triggered a sharper sell-off across precious metals. Second, geopolitical tensions. From US-Iran frictions to wider global uncertainties are keeping demand strong. Central banks worldwide, led by China, are buying gold at a record pace to diversify reserves and reduce reliance on the US dollar.
Now, many of the central banks around the world is once again recognizing gold's role in diversifying a central bank's reserve.
Third, speculation. In highly leveraged markets, small moves can snowball fast. Earlier this year, investors crowded into gold. When the Fed turned more hawkish, the first domino fell. Over-leveraged traders faced margin calls and were forced to sell. That's how leverage can supercharge volatility. So let's connect the dots. Gold's wild swings aren't random. They reflect shifting expectations around US monetary policy, raising geopolitical tensions and investor behavior, pointing to deeper change in global supply and demand. As uncertainty grows, confidence in the US dollar is being tested, and countries are responding by reducing dollar exposure.